What's happening at Glanbia? Challenges and future prospects. Glanbia, a name synonymous with nutrition and wellness, is currently facing a storm that has left many scratching their heads. How did a company that once thrived in the booming protein market find itself back at a share price of €11, a level it hasn't seen in over a decade? Despite being larger and possessing more assets than ever, Glanbia has seen its market value plummet by over €2 billion in less than 10 months. This is particularly puzzling given that they own Optimum Nutrition, one of the most popular protein powder brands, which even sponsors the McLaren Formula One team. Once the go-to for bodybuilders and fitness enthusiasts, protein powders have now become a staple for everyday consumers. So, why isn't Glanbia reaping the rewards? Critics argue that the company has drifted too far from its core strengths as a B2B, business-to-business, ingredients provider and is struggling to manage its consumer-facing brands effectively. The performance nutrition segment, which contributes more than half of Glanbia's earnings, is a patchwork of various brands like Optimum Nutrition, Isopure, and SlimFast, many of which have lost value since joining the Glanbia family. Even Optimum Nutrition, once a shining star, is reportedly underperforming. One institutional investor pointed out that Glanbia lacks the robust distribution channels of giants like Coca-Cola or Nestle, which has hindered their ability to connect with consumers effectively. This distribution gap may also explain why Glanbia has been slow to transition from basic protein powders to the rapidly expanding protein drinks market. Adding to the woes, some critics believe that Glanbia has made a series of poor acquisitions that have failed to enhance the company's value. A prime example is the 2018 purchase of SlimFast for $350 million, which has since been marked down significantly due to declining sales. The once popular weight loss brand has struggled to keep up with changing consumer preferences, as more people now favor active weight loss programs over meal replacements. As a result, SlimFast is now up for auction, likely to sell for a fraction of its original price. Despite these challenges, Glanbia seems to be doubling down on its M&A strategy, promoting Hugh Maguire, the architect behind many of these acquisitions, to CEO last year. This decision has raised eyebrows, especially as shareholders express their frustration over the company's performance. Another significant concern among investors is Glanbia's unwieldy corporate structure, which encompasses three distinct business areas: sports nutrition, ingredients, and dairy. This complexity has made it difficult for investors to assess the company's value and has led to calls for a separation of these business units. Gianluca Ferrari, head of Clearway Capital, voiced this sentiment at a recent AGM, suggesting that the current structure is amplifying volatility rather than mitigating it. The company's recent profit warning, linked to soaring whey prices, has only added fuel to the fire, causing a sharp 25% drop in share price. Ferrari pointed out that if a company like Ryanair's CEO blamed external factors for a similar drop, he would likely be out of a job. Glanbia's management, however, insists that the surge in whey prices is a cyclical issue and that they are working to mitigate its impact. Shareholder discontent is further exacerbated by the generous compensation packages awarded to executives during this period of underperformance. Over the past decade, Glanbia has paid out €81 million in director remuneration, coinciding with a staggering 36% decline in total shareholder returns. The former CEO, Siobhan Talbot, received an €8 million exit package, while the current CFO, Mark Garvey, took home €3.6 million last year. As Glanbia navigates these turbulent waters, Turbulent, the farmer-led co-op that owns 29% of the company, has remained a silent observer. However, with the upcoming AGMs for both Glanbia and Turbulent, there is a growing sense of urgency for change. Turbulent's shareholders are set to receive significantly less than expected due to the drop in Glanbia's share price, and the co-op may be forced to dilute its holdings to meet obligations related to a convertible bond. The question remains, will Turbulent join other institutional investors in pushing for a strategic overhaul of Glanbia? As the status quo becomes increasingly untenable, the pressure for a clear path forward is mounting. The coming months will be crucial for Glanbia as it seeks to regain its footing in a competitive market.